Our next presenter, Sekhar Vemparala, is a senior advisor and principal of Wealth Planning Advisory Group, founder and creator of wealthDNA. wealthDNA. wealthDNA is a unique process that is designed to discover your individual wealth signature, has markers that will help manage, accumulate, and distribute your wealth with the greatest tax efficiency. That's interesting. His process has been adopted by many affluent clients who create successful estate and legacy plans using this process. So I'd like to welcome Sekhar Vemparala.
Thank you, Joe. So, in the spirit of continuing Joe's earlier discussion about people meeting at Convene, there was a politician, there was a physician, there was a financial advisor, and an accountant, and of course, can't live without an attorney. So they were all there. And as things happened, they got into a little bit of a discussion. And then they said, who's really good? Who's better than the other? So the attorney said, you can't even live a day without me, so I'm the best. The politician said, I run things. The financial advisor said, it's all about the money. And the accountant said, I do all the counting, so you can't live without me. So they all decided, the attorney spoke up and said, you know what, let's just settle this. I'll just tweet God. So tweeted God, got an instant reply. She said, hey, I created everyone equally on the planet. No one is better than anybody else. But anyway, since you asked, I want to just give you a piece of advice. We're all important. We're all equal, okay? Signed, God, MD. So, we're here to talk about a few things, and financial planning can get complicated. And a lot of times, money is at the center of things. How do you manage it? What do you do with it? You can be successful. You can be very successful with it. Or sometimes you can make costly mistakes. So today's presentation is Financial Planning 101. Irrespective of where you are and what your future looks like, I have a few comments on how can you be successful with money management. So this is a public service announcement. You can use most of the, I would call it, nuggets of wisdom that we've compiled together just for today. So some common pitfalls to avoid. Where can you go wrong? We live in an anesthetized economy. What does this mean? What's happening is because of the level of information that's coming to us, everything is about disclosures. 30 years ago in financial planning, the disclosures or any disclaimers were 1 page. Today, it's 4 inches thick. And that applies to every industry. It isn't finance, it's healthcare, as you heard from Mr. Fader earlier. It's all about complying. It's all about compliance. So in every industry, there's compliance. And what has happened over time is because of the level of complexity, we've become numb and dumb. So we live in an anesthetized economy. Let me give you a few examples. Anybody who's bought a home or is planning to buy a home will recognize that most of the time you'll have to go get a mortgage. I call it mortgage financial liposuction because most people who buy a home end up financing it, but then they wait a few years and then they get a call from their banker and the banker goes something like, interest rates have been going down. You may want to refinance your home. How much are you paying today? and so on and so forth. So the conversation goes on. And I just want to kind of take a quick example. An amortization schedule is what you get. This is a technical word, an amortization. Amortization simply means equal payments. Equal payments means that you pay the same amount of money every month for 15 years or 30 years, and at the end of that period, you own the home, right? So you do that. So in this example, if I were to go get a mortgage on a $400,000 home, I'd have to put 20% down. So I borrow $320,000 from the bank. So the bank gives me $320,000, and assuming a 5% interest rate, my monthly payment is about $1,700. That's what I have to pay. Now, what the bank does is they say, hey, you pay me $1,700. However, this $1,700 is going to be broken into two components. It's going to be broken into what we call as interest. That's the amount of money I will charge you, the 5% per year, and then principal. And over 30 years, you would have paid me back. So what happens is you start with a payment of $1,700, and because the bank says it's principal and interest, they'll apply $1,333 to interest in the first month, and principal would be $384. Now, if you look at month 360, which is 30 years later, the interest would be, say, $384, and the principal might be $1,333. So it reverses itself. So what happens is this is very front-loaded. The bank wants to get all the interest up front. So 5 years later, in this example, in month 61, you say, okay, I paid $1,700 in the first month. I continue to pay the same amount of money. And the cumulative interest in month 60 or 61 is about a little less than 70. It's a little less than $80,000. So you've paid $78,000 in cumulative interest. And guess what? You've already paid $103,000 by this point in time. And if you want to now listen to the banker who calls you and says, you know what, you should really sit down and let me host you for lunch. I can reduce your payment to $1,500. That will put $217 in your pocket. You say, oh, that's half a car payment, that's good. Why don't I do this? What's wrong with that picture? Well, when you refinance, you still owe the banker $293,000. What's happened here? You start a new clock. You started with $320,000. 5 years later, you still owe a little less than $300,000. So $27,000 is all you paid off in principal, so you're starting a brand new clock. So if you're thinking about refinancing a home, my suggestion to you is don't do it unless you really sit down and work the math out. I'm not suggesting that refinancing is bad. I'm simply saying know your facts before you refinance, because don't look at the cash flow only. The great bank robbery here is the fact that you're starting a brand new clock. And if you keep doing this every 5 years, it'll be called financial liposuction. The other thing is credit cards. We all need it, we all have it, but a lot of times there's a bait and switch. Hey, here's a 0% for the first 6 months. What happens after the first 6 months if you don't watch out? You've tapped into it because it's 0%. You've borrowed $3,000 or $5,000, and now what's happening is we've switched it around. It's 27% interest. So from time to time, what everybody needs to do is look at all the credit cards they have, and that could be an annual ritual, every 6 months, every year. Take a look at cards. In fact, you know what? I'm going to do that right now. I kept my wallet here. I have a lot of cards. So let's see. Are there any unwanted cards here? This one right here. This is 27% interest, okay? What I'm going to do is I'm just going to cut this card. I don't need this card anymore. You know why? That's called plastic surgery. So what you really need to do is look at your cards, look at what interest rate you're paying. Can you refinance some of your cards? Can you go to your bank and say, can I borrow against my home, or can I get a 4% interest rate? And every so often, you need to cosmetically get your plastic surgery done so that you're not paying too much interest, because the interest over a period of time can kill you, right? You also have to figure out how you need to pay yourself first. Paying yourself first simply means that we live in a fixed income world, right? So we get a paycheck and we say, okay, I got to pay my car payment, I got to pay my phone bill, I got to pay for my house or rent. But a good idea would be to start saving early. Pay yourself first. We really live in a net paycheck world, right? When you get a paycheck, it's broken down into several things. Let's say the paycheck is $3,000 or $5,000. Whatever that paycheck is, every time you look at the paycheck, 7.5%, a little over 7.5% is taken away for taxes, Social Security taxes. And then a few other things, unemployment tax, disability tax, workman comp, all of those things, you get a gross paycheck and a net paycheck. And generally, the net paycheck is about 25 to 30% lower. We never think about our gross paycheck. We only think about our net paycheck because that's what we live on, right? So if you incorporated savings into the equation, if you can give up 7.5% for taxes, can you also give up 5 or 7% for savings? And sometimes your employer would have a 401k plan, or if you're working for a hospital, a 403b plan. Whatever plan there is, it's a retirement plan, and it's a good idea to put your money in there. Because every time you put in money in a tax-deferred plan, which is a 401k plan, it's tax deductible, which means the dollar isn't costing you the whole dollar. It's only costing you 75 cents, right? So if you put $1 away in a 401k plan, if you put away $1,000 a month, $12,000 a year, or $500 a month, which is $6,000 a year, even start lower. It's $200 a month. That's $2,400 a year. It's not costing you the whole $2,400. It's costing you less. So the actual cost is reduced by 25%. So that's what you need to do. You know, why is it important to do that? Because if you start saving, you start early, and you increase the amounts over a period of time. Einstein said this, by the way. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Okay? Einstein was very fascinated with the concept of compound interest. And what is compound interest? I'll give you a simple example. If you had $100 and you earned 5% on the $100, at the end of the year, you would have $5 in earning. The next year, you would have 105 to begin with. So you earn interest on the 105, not the 100. That's called compounding. So over a period of time, the compounding can get exponential. When it gets exponential, you'll have a pot of money in the end. So that's why compound interest is important. Harness the power of compounding. You put $2,000, your employer matches it. Now you have $4,000. Just watch your money grow. And that's compound interest for you. So if somebody was age 30 and put away $365 a month or $360 a month and just stopped at age 40, okay, because of the compounding, they would have, at age 40, they would have close to $60,000. They would have put in $36,000 and they would have close to $60,000. By age 50, they would already have 109. By age 65, all they've put in is $360 a month. They would have over $250,000.
This is what interest accruement after 40?
I would say about 5%. Okay. So here's the thing. Now, somebody started a little late because life happened. They said, you know what, I can't save. I got to pay my student loan back. I got to go buy a house. I got to pay for my car. That's called living life, right? So you say, you know what, I can't save right now. I'm just going to wait for a little while. So they started at age 40 instead of age 30. Obviously, they'll have 10 less years. But look at the difference. $147,000 at age 65 versus $267,000 at 65. They both contributed the same 10 years. But saving early makes the difference, right? If you started at age 40 and stop at age 50, you have roughly $120,000 less at age 65. It's the same amount of money. So if you can start early, save more, that's what you really need to do. Now we want to talk about investing. And this is, I'm going to keep everything at the 101 level, and I welcome questions. Thanks for your question. So this is simply put what we call as the cornerstones of investing, right? Everybody should look at their annual pay, which will obviously go up in the future, but you always need to put away about 6 months for emergencies, right? This is 6 months of expenses if you got sick, if you got disabled, if you had an emergency, or you lost your job, or you're in transition, you want to take a sabbatical, have a baby, whatever. 6 months of living expenses. The first cornerstone is the 6 months of living expenses, and we call this dollars that we live by, right? So then we also want to look at what can we do for the next year. So we can't invest the 6 months of money or the 1 year money into something that can go up and down. So beyond that, if you have money left over, we can now begin to think of investing this money. So there are two ways to invest your money. You can have it grow in a secure manner, or you can have it grow with what we call as the stock market or equities, right? So this can grow in two different ways. Fixed income is bonds. It's another word for bonds. And stocks, another word for stocks is equities. So those are the dollars that we grow by. So the four cornerstone principle of investing simply tells us the short-term dollars or the emergency money or the 1 year money, I can't really play with it. So I'm just going to keep it in a savings account or a money market account, so it'll be there for me when I need it. So there are three kinds of main assets: cash, bonds, and stocks. Now I've oversimplified this. If you talk to an investment manager or a portfolio manager, they'll tell you those aren't the only three types of investments. There's a whole bunch of other asset classes and so on and so forth. But for simplicity, there are three main kinds of investments. There's cash, there's bonds, and there's stocks. So you pick your nectar. You know, you want safety and security over risk. You would want to stick with cash or bonds. If you want to take a little more risk, it's stocks. Why is it green, yellow, and red? Well, it's not really green, yellow, or red. It's just that these behave in different ways as to where they could be at a designated period of time. So let's look at this. What do these charts have in common? The one on the left is a chart. The one on the right is also a chart. One is from the healthcare industry and the other is from the financial industry, but they both look alike, don't they? Okay, the chart in the left is when somebody is having a cardiac arrest. It's an EKG chart. It goes up and down. But if you look at it, that's normal. At 8 o'clock and 8:05, it starts to go wild, right? The one on the right also looks like an EKG chart. It goes up and down, but in December, it started looking like the cardiac arrest in a 1-month period, right? And that's when the boat starts going down. You're in turbulent waters. But over a long period of time, we're talking about 5 to 10 years, time diffuses risk. Now things look more or less normal. Okay, you're walking down the street, you're jogging, everything's fine, you maintain your heartbeat. It can go up temporarily, but it's back again to the normal thing, right? The same thing happens with the stock market. Except for times where it can go down, and we call that, a crazy stock market, or everything's down, or it's a bear market. You've heard these terms. But most of the time, it could be just like canoeing in a lake, smooth sailing. There's no issues, right? So time diffuses risk. So if we had to go back, which would you pick? Would you pick cash, bonds, or stocks? Okay? Stocks over a long period of time arguably will give you the best rate of return. But you have to be in the market to be there and win it. You cannot go in and out of the market and time the market. It's not timing the market, it's time in the market. So stocks, arguably over a long period of time, will give you the best return, but you have to be able to have the patience to sustain the ups and downs in order to get the reward. The real reward is in the long term being with equities, because over a long period of time, traditionally, and we're talking about 10, 15, 20, 30-year time frames, stocks have returned on average in excess of 8%. Bonds, on the other hand, have been between 4 and 6. And cash or cash equivalents or money market accounts have returned roughly 2 to 4%. So you're only dealing with risk, and risk is diffused over time. So if you have time on your side, you can actually afford to be in stocks. Now, obviously, some people prefer not to have any volatility, and they can't get sleep at night if the market goes down. And if you're that type of a person, then you would want to be in more secure, safe investments and talk to a financial advisor who can help you. All right, let's talk about taxes for a minute, right? I call this the tax triangle. There's only 3 ways to invest money. You can invest money before taxes, make it tax deductible, or you can make it tax-free. So money that is pre-tax can grow tax deferred. Here's the example of a retirement plan, a 401k plan. So the money goes in, it becomes tax deductible, and then it's tax deferred, but when it comes out, it's taxable. You can put after-tax monies in that are taxable, and when you take it out, they could potentially be tax-free, or you'd have to pay taxes, right? What you need to remember is, at the end of the day, taxes are an important component. Idiopathic tax myopathy. Some of my healthcare friends will help me explain what this is, but I checked with a physician, what does idiopathic mean, because I had to look it up. I'm not a physician, I'm a financial advisor. I was told that idiopathic simply means that there's no known reason. And then I asked him, what's myopathy? Myopathy is just disease, okay? So I said, I'm going to use the term. I said idiopathic tax myopathy, okay? There is no known reason to mankind as to why anybody has to pay more taxes than is needed, right? So you have tax control, and that's what this triangle does. You can have your cake and eat it too. You can put in monies in a tax deferred status and potentially get it tax free. How can you do that? Well, there are ways of doing that beyond the scope of today's discussion. Again, a financial advisor can help you really understand how to control your taxes with pre-tax money, post-tax money, potentially leveraging the tax triangle to maximize your tax efficiency with the money that you make. Because the fact of the matter is, over a long period of time, you can make more money saving taxes than you can by making more money. Let me repeat that. You can make more money saving taxes than you can by making more money. Because making more money in the end makes it taxable, so what's left is very little, right? So the tax control is very important, and like Einstein said, the compounding of the interest combined with tax planning should give you the best results. So eventually, whether you're starting out, whether you put in 5 years into your field, or whether you're in the middle, or whether you're towards the end, someday you'll meet success. And when you do, you will have a few dollars extra because you're successful. So that's when you need to talk to an attorney like Mr. Fader, who can help you with trusts and estates, or tax and estate planning, or asset protection, because we live in a very predatory world. At some point in time, if you're there in the business long enough or you work long enough, you're either going to get sued or you're going to sue somebody. So how do you protect your assets from creditors and predators? And that's a topic for a tax attorney or a corporate attorney to help you shield some of your wealth through family limited partnerships or trusts. All these are just words, but essentially what they mean is that they can help you in a certain way to help protect those assets. That's me. If you need any advice, you can write a quick email to Maria asking your question, and we'll be happy to reply. No problem there. Any questions? Love any questions from anybody at this point in time. So the question was, I am in a hospital today and I have a 401k or a 403b plan, and I'm thinking of switching my job. I'm joining a physician's practice, or I'm taking it to another hospital. What do I do with the money that I have in my 403b plan or 401k plan? Is that the question?
Correct.
Okay, it's very simple. It's called a tax-free exchange. So your 401k plan usually has a custodian. The custodian could be a company such as Fidelity or Charles Schwab or T. Rowe Price or Vanguard or whatever custodian is there. In your new place of employment, they may have a 401k plan, and you can simply port this 401k plan and roll it into that one. Or sometimes that's not possible because they're not compatible, they don't want to talk to each other. And at that point in time, you can roll it into a personal IRA, which is an individual retirement account, without the incidence of taxation. If you were to distribute it, and sometimes people don't know this, they think that they don't have a choice, they'll say, distribute my assets, and because you check the box, which is usually box D, other than A, B, and C, they'll simply send you a check. But after the holidays and sometime in the first or the second week of January, you'll get a nice little statement. It'll say something called 1099-R. And you look at it and you say, what is this? I know what a 1040 is, that's my tax return. What's a 1099-R? It says R in the end. Well, that's called a retirement distribution. You just distributed your assets, and it's too late to unring the bell because you said, I want my assets. If you're below 59.5, you pay a 10% penalty. On top of it, that's considered taxable income. So if you distributed $25,000, you got to pay a 10% penalty of $2,500, and that $25,000 is considered income to you. So don't do that unless you absolutely have to. You can simply roll it into another 401k plan, or you can roll it into your individual retirement account, and that would be the right thing to do. And as always, in the spirit of disclaimers and disclosures, check with your tax attorney. So with respect to your 401k, should you do Roth or should you just put it in a 401k? Okay, that's the question. Okay, let's understand what Roth is. Okay, you've heard the word Roth. So there was a senator, his name was Roth, and he came up with an idea. He says, you know what? All this money is going to be postponing my taxes at a later point in time. It's tax deductible, I get it, and it's growing tax deferred, but in the end, the government is waiting and saying, I want my share. So it's taxable on the other end. So he came up with a plan and he says, hey, why don't I not take the tax deduction now? So if I'm putting away $5,000, I don't want a tax deduction now. I'm maybe in a lower tax bracket, but on the other end, I want it tax-free, and that would be a great thing. So if you're starting out early on, a Roth is not a bad idea because I'm putting in the money not tax deductible. I'm putting in the $5,000, and I do have to pay the taxes today, but go forward 30 years, and because of what Einstein said, compound interest, I'm getting all of that money. And if you FANG those assets, FANG is just an acronym for Facebook, Apple, Netflix, Google, that kind of thing. And it hyper grows, and over a period of time, you didn't have to pay taxes. A $5,000 investment could be over $1 million by the time you retire. And I'm not kidding, just look it up. Just go back and see what happens to Uber or Amazon or Apple or some of those stocks that you invested 10 or 15 years ago, and what happens to the value. So in a situation like that, putting money in a Roth makes absolute sense. But again, it's individual circumstances. Check with your accountant, check with your tax advisor. But this could be a great strategy. It's Roth and roll. Yes, please, Uma.
Can you have both? Can you have 401k and a 401k Roth?
You could. And you can also convert some of your assets to a Roth. Again, a CPA will tell you what you can and cannot do. I shouldn't answer that generically because there are exceptions. Not everybody is allowed because of certain limitations of income. You may not be able to put all the money in a Roth if you make above a certain amount. You can also convert an existing IRA into a Roth IRA or a 401k into a Roth 401k. But you should check with your advisor. Great question. Other questions? I'm dismissed. One more.
Wait, did you discuss CDs at all?
You mean certificates of depreciation or certificates of deposit? CDs. CDs. Oh, I'm sorry. Yeah. I thought they did away with CDs because now everything is digital. But I'll answer your question. CDs are also known as term deposits. So if I have $10,000 and I want to invest it, I have choices. I can put it in a money market account, I can put it in a CD, I can put it in a bond, or I can put it in stocks. Now, it depends on what the goal for that $10,000 is. If it is for a wedding in 2 years or a down payment for a house, which is in the next year or so, I don't want to play with that money. I want to make sure that when the time comes, I have the money for the intended purpose. So if it's short term, I would say a CD is a good alternative because now rates are edging up. They're above 2%. 3 or 4 years ago, you almost had to pay the bank to hold your CD. They were close to zero. Right now, they're going up a little bit, right? So a CD is also known as a certificate of deposit. It simply means that you deposit your money at the end of the term. When it matures, you get your stated interest rate along with the principal. So for short-term money, CDs are okay. You could also look at treasuries, but treasuries are interest rate sensitive. CDs wouldn't be. So what you see is what you get. Again, check with your advisor. You've been a great audience. Thank you for tuning in. Thank you for listening. And we have a little giveaway here. It's a book. It's called The Laws of Lifetime Growth. Everything you already know, written by a great author. His name is Dan Sullivan. He runs a company called The Strategic Coach. This is for advice for entrepreneurs or professionals who want to improve their professional and personal life. So Harvey is going to give each of you a copy. This is just a notebook. This talks about a process of financial planning, but it's like any other process. And I would recommend, last comment for the day is this is again a public service announcement. It's not a commercial. So please take it that way. I would always recommend that you check with a qualified professional in any field, whether it's legal, accounting, financial planning, investment advice. And the reason for that is there are platforms that are technology-driven, AI-driven, artificial intelligence. There's a platform called a robo-advisory platform. Sounds a little mechanical, right? But there's a softer version of it. It's called Betterment. But betterment means that it's going to better your finances at the end of the day by working with them. These are technology-driven platforms. You answer a series of questions, and in the end, it tells you how to invest your money, for better or for worse. Now, those platforms haven't necessarily been better. It's been better for the company, but not better for the investor. And the reason for that is in terms of volatility, AI can't figure out what to do. AI can't figure out what the emotions are. AI can't figure out that the needs have changed unless you go tell it, right? So a person, toe-to-toe, old-fashioned way, can take into account all of those factors and considerations. So always check with a professional advisor.